Welcome to this explainer. Okay, picture this. When a massive corporation buys another company for billions of dollars, they're not just buying buildings, inventory, or, office desks. They're actually buying reputation. They're buying brand identity and customer loyalty. But, and here's the million-dollar question, how does the US government tax an asset that is literally invisible? Today, we're acting as financial detectives. We're going to crack open the U.S. tax code, specifically Section 197, and look at a really fascinating private letter ruling from the IRS. We'll see exactly how corporations navigate and, honestly, sometimes completely master these incredibly complex rules.
So let's dive right into this puzzle that has literally plagued accountants and lawmakers for decades. Think about it. If a company buys a warehouse, they can physically touch the walls, they can measure the square footage, and it's pretty easy to calculate depreciation as that physical building ages, right? But what happens when millions or even billions of dollars in a corporate buyout are tied to things you simply cannot touch? How do you put a value on, and more importantly, how do you tax the sheer invisible wealth of a solid business?
To solve this mystery, here's our roadmap. We're going to cover taxing the invisible asset, the 1993 tax code fix, exceptions to the rule, the mystery corporation case, and finally, the IRS verdict.
Let's kick things off with Section 1, taxing the invisible asset, and define exactly what we mean here. Now, Goodwill is the ultimate invisible asset. And no, we aren't talking about charity here. Goodwill is the massive premium a company commands just because of its good name. Let's say a business's physical assets, the real estate, the servers, the inventory, the whole shebang, are worth $100,000. But the business itself sells for $500,000. Well, that $400,000 gap, that's goodwill. It's the calculated, hard financial value of the fact that customers already trust the brand and will predictably keep spending their money there. But Goodwill is definitely not flying solo here. The tax code actually identifies a massive roster of these intangible items that carry incredible financial weight. We're talking about having a highly trained workforce already in place, proprietary operating systems, patents, copyrights, and even things like guaranteed market share or rock-solid vendor relationships. Add government licenses, non-compete clauses, and franchises to that list too. Honestly, for decades, trying to figure out how to precisely tax the transfer of all these invisible items was just absolute chaos. Moving right along to Section 2, the 1993 tax code fix, where the government tries to standardize all these intangibles. So historically, you couldn't just deduct the exhaustion of goodwill over time. It was treated as a non-amortizable capital asset. Basically, the IRS saw it as something that didn't just waste away, so you couldn't write off a chunk of it every year as a standard business expense. But then, in August 1993, Congress completely changed the game. They enacted Section 197 into the U.S. Code. This gave businesses a clean, predictable way to deduct the costs of buying these intangible assets. They even allowed companies to retroactively apply this rule back to July 1991 if they made a valid election. Talk about a major shift. Now, here's where it gets really interesting. Under this new rule, the cost of acquired intangible assets must be amortized evenly over exactly 15 years. No exceptions. It doesn't matter if you buy a patent that expires in 5 years or a trademark that basically lasts forever. If it falls under Section 197, you just take the purchase price of that asset, divide it by 15, and boom, that's your ordinary deduction on your taxes every single year. It was supposed to be simple. But as we all know with tax law, simple usually just creates a whole new set of complex boundaries to navigate. And the stakes here are absolutely massive. Take a look at this. If an asset is categorized as a Section 197 intangible, it gets that 15-year ordinary deduction. But if it falls outside of Section 197, it often reverts to being a capital asset under Section 1221. So why is this such a big deal for corporate accountants? Well, historically, capital gains are taxed at a much, much lower rate than ordinary income. If you're a corporation selling off a massive division, you are going to fight tooth and nail for that favorable capital gains rate. It is an absolute game changer. Which brings us to Section 3, exceptions to the rule, and how this builds into a huge legal gray area. This comparison right here reveals a massive loophole. Section 197 generally only applies to intangibles you buy, not the ones you create yourself. The tax code explicitly states that amortizable Section 197 intangibles do not include anything created by the taxpayer. Think about that for a second. If you spend 20 years building incredible brand loyalty and goodwill from scratch, you didn't buy it, you built it, and therefore it is entirely excluded from that 15-year Section 197 rule. And it doesn't stop there. The law also narrowed down exactly what the IRS can force into that 15-year box. Financial interests in corporations, land interests, off-the-shelf computer software, separately acquired patents, existing leases, mortgage servicing rights, all of these are explicitly excluded from Section 197. For tax planners, this list is basically a treasure map. If you can fit your asset into one of these specific categories or prove that it was self-created, you completely sidestep Section 197 treatment. It's brilliant. Let's see this in action in Section 4, the Mystery Corporation Case, a true, real-world puzzle. Back in 2002, a company executed a massive corporate sale, and, smartly, they went straight to the IRS for a private ruling to make sure they wouldn't get hit with a nasty surprise tax bill down the road. Now, the IRS obviously redacts names in these documents for privacy, so we're just going to call them the Mystery Corporation. They wanted to know exactly how the government would treat a highly specific, very calculated liquidation of their assets.
So the company executed 3 very deliberate steps. First, they decided to focus solely on their Division Z, which meant selling off Divisions X and Y. But here's the kicker. They didn't just sell them cleanly. They fragmented the sale into roughly 20 separate asset and stock transactions. Now, here is the absolute brilliance of this tax maneuver. After assigning fair market value to tangible things like equipment and real estate, they took the massive leftover residual sale price and dumped it entirely into Goodwill and going concern value. It all came down to their timeline. They went to the IRS and essentially argued that the goodwill in these 20 sales was completely exempt from Section 197. Why? Well, they claimed it was either goodwill they had created themselves from scratch, or it was goodwill they'd acquired from third parties before August 11, 1993, literally the exact day the law was enacted. By meticulously boxing their goodwill into these very specific exempt categories, they were practically daring the IRS to dispute it. All right, let's hit the climax in Section 5. The IRS delivers a verdict. Time for the high-stakes decision.
The IRS was totally cornered here. They had to make a call. Was this goodwill forced into the 15-year amortization rule, or was it a capital asset subject to much better tax rates under Section 1221? See, the rules explicitly state that a Section 197 asset is treated as depreciable property and is definitely not a capital asset. But if you look back at decades of pre-1993 settled law, goodwill had always been a non-amortizable capital asset. So what exactly happens to the self-created and pre-1993 goodwill that bypasses those new rules entirely?
Well, in a massive victory for corporate tax planners everywhere, the IRS actually agreed. Because this company flawlessly navigated those timeline exceptions, the IRS ruled that their goodwill escaped Section 197 and defaulted right back to the old rules. They officially granted the goodwill highly favorable capital asset status under Section 1221. Just by carefully structuring their sale and understanding the literal exact boundaries of the tax code, this mystery corporation saved an absolute fortune in taxes.
You know, Section 197 was originally supposed to simplify things, but honestly, it kind of just created a much more lucrative game board. If you can prove you built your own reputation or track an asset's acquisition date perfectly, the tax savings are just astronomical. It really makes you wonder, the next time you see a multi-billion-dollar corporate buyout on the news, how much of that massive price tag is actually just a carefully categorized, invisible illusion designed to beat the tax code? Thanks for joining me on this explainer. I'll catch you next time.